mortgage talk, and more. And I am your host, Mark Hairston. And if you're a regular to the show, you'll know that I usually have a guest with me, maybe one or two guests. But today I'm going to go solo because I thought it would be kind of fun to look at some questions. And some very common questions that people ask me in the mortgage space about how to get a mortgage and how to shop for a mortgage and what are the benefits of different types of loans, that sort of thing. So I put down 10 questions. We may not be able to get through all of them, but we'll do the best we can. So the first thing people ask me is, what help me understand the mortgage process and the home buying process kind of from start to finish. Certainly first time buyers do this a lot. But other people do too who haven't bought a home in 5 or 10 years. So I want to kind of walk you through the steps. The first step when you're looking to buy a residential property, whether it be an investment property or one that you want to live in, you want to get pre-qualified first. I can't tell you how many people come in and want to shop for a property, let's say a $500,000 home or $600,000 home, and it's way outside their budget. So the first thing you want to do is get what we call your ducks in a row, your financials, your W-2s, your tax statements, your income statements. We're going to run your credit. We want to look at your asset base. And from there, we can define how much you can borrow so you won't be shopping for something that's outside your budget or outside of your qualification. That's the first thing to do. And then the process goes into getting pre-qualified or pre-approved, and then you contract on a house. You hire a realtor typically, get with a real estate agent who knows your area. Let's say you want to live in Round Rock or Dripping Springs, and find somebody who's qualified in that market. You don't want to find somebody who lives in Kyle to sell you a house in Jarrell, as an example, typically, because most realtors focus on certain areas. And then once you contract on a house, you negotiate the price, you negotiate repairs, typically those two things up front. And then we move into the process of the loan, which will get appraisal ordered. We will update any documentation. If it's been a few months since you applied, we're going to need to update your pay stubs and bank statements and things like that. If we need a survey, we'll get the survey ordered, the title work. The title company then comes into play to make sure we have enough the insurance on the title for you. And then we move into underwriting. Underwriting is a step of final approval. And I work as a mortgage broker. I work with lots of different companies, but the guidelines are pretty much the same from company to company. They're sort of standardized. But the underwriter will look over everything, and if something we missed in the process, they'll let us know that you're approved with these conditions. Conditions could be an updated pay stub or an explanation on something. And then once we clear all those conditions, you're what we call clear to close, which means everything has been done on the loan. We're preparing the paperwork for the attorneys, the legal paperwork in order to close the loan for you. And then that step is we go to the title company, or the buyer will go to the title company with their real estate agent typically, and sign all the legal paperwork, and the seller will be there and sign all the paperwork to fund the loan, and then it's yours. And then the keys will be transferred that day. So that's kind of how it works on a 30,000 foot look at the process. That usually takes 3 to 4 weeks. In the old days, and I've been doing this 40 years, in the old days, it would take 6 to 7 weeks. So there's a lot of efficiencies now in the industry that we didn't have, a few decades ago, which has been great because some people need to move very quickly, especially relocation buyers who want to come in and buy something quickly and close fast, especially in the summer when you're trying to get settled in for schools and things like that. So that's kind of the process. And so the next question that usually comes up is, what is a mortgage broker and their role when getting a loan? And in the past, and on this show, I've shared a white paper that I wrote years ago called The Truth in Lending, where I disclose or share with people 3 basic channels of getting financed on a residential property. Again, we don't do anything in the commercial space. We can't do, we don't do land loans or buildings. We just do homes. And in the mortgage world, there's credit unions that'll do loans, and banks, I should say. There's large mortgage companies there's large mortgage companies, and then there's mortgage brokers. And my channel of loans is a mortgage broker. I'm independent, which means I don't deal with one company. So I don't deal with one bank or one credit union. I shop these loans all over the country. I have about 20 different relationships around the country. And these investors, or what we call lenders, will have a certain appetite for the kind of loan they want to make. It may be high balance loans, or it may be low credit score loans, or it may be for investors. There's all sorts of reasons these lenders are in business, and they're looking for a certain profile. and I take the data as a mortgage broker. I'm a middleman between the borrower, in your case, and the end user or the end seller. And a lot of times you cannot go to these institutions by yourself to get a loan. You have to use somebody like a mortgage broker in order to handle the process and the paperwork. And again, these lenders pay us as a fee to do the loans for them. The borrower doesn't pay us anything. The lender typically will do that. So that's how we get paid a commission based on different types of loan products. You can get a loan from lots of places, and again, the process is very similar from company to company. The guidelines are similar, the paperwork's very similar. But what you may find is a mortgage broker typically is going to get you a little bit better interest rate than a big bank or a big mortgage company. And so in this market, where rates are floating between 6.5% and 7%, every eighth or quarter or certainly 0.5% of rate makes a huge difference in your mortgage payment. So again, shop it out. If you want information on my white paper, give me a call at 512-789-6967. I'll be happy to send that over to you. It's 15 pages. It's sort of a behind the scenes look at how to get a mortgage loan in this world. Next question is kind of can you explain the different types of mortgage loans available? Now, this is this is a big subject, so I'm going to try to give you the basics and call me with any questions around that. But there's two basic categories of residential loans. They're called QM loans, which means qualified mortgage, QM, qualified mortgage, and there's non-QM loans. Imagine that. So there's two basic types of categories of loans. The first, meaning a qualified mortgage, is your traditional types of financing. When I got in the mortgage business in 1985, there were only three basic products. There was conventional financing, there was FHA, and there was VA. Now that's all changed. There's a whole new array of different types of product mix these days for different types of people. But those are still in the QM world, those are the basics, what we call agency loans, which means that Fannie Mae or Freddie Mac, the secondary market, has the guidelines. And if you meet those guidelines, you're going to fall into the QM category, which is most of the business we do in Austin because the interest rates are the best. If you can qualify in the QM world, like FHA or VA or USDA or conventional, your rates are going to be a lot better than if you can't qualify in that category. If you can't, then we can look at what we call the non-QM loans. And these are independent lenders that make their own loans and make up their own guidelines. They're usually banks or they're larger mortgage companies who securitize their portfolio and they sell them into Wall Street or other investments. But they're usually priced higher, but they have less, if you will, regulation or paperwork or guidelines. Some of my loans don't require that you really show any income in the traditional sense. So if you're self-employed and you write off a lot of your income for tax purposes and you can't qualify in the traditional loan, you may go what we call non-QM. And the guidelines usually want a little more money down than traditional loans. And the rates are a little bit higher. But again, your paperwork is less because we may want to see your year of bank statements to see that you have cash flow, but we don't really document it like with tax returns and pay stubs and W-2s and things like that. So again, non-QM loans are very popular with investors who buy in rental properties, who maybe have several properties and they can't get a traditional Fannie Mae or QM type of loan, and they have to go to these alternative financing, which the underwriting is usually a lot easier, but the rates are higher. So that's the downside. There's always pros and cons. And what we do as a mortgage broker is to take your profile and try to get you fit into the best product that we can. And of course, if you're a veteran, then most likely you want to get a VA loan. If your credit scores are a little low, maybe FHA is the best product for you. If you're an investor, maybe a non-QM loan. So we look at all the options for you and try to fit you into the best product for you. So that kind of speaks to the next question is, what are some of the typical down payment requirements for different types of loans? And when I started back in the day, you had to put down at least 5% on a conventional loan or 3% on an FHA, or VA, of course, is zero down. Now, VA loans have been around since World War II. So the veterans coming back from World War II, the VA, the government stepped in and said, we want to do something special for veterans, even back in the 40s. and they created this, it used to be called the GI Bill, where veterans could come back and buy a property after the war with zero down. Those guidelines have not changed. Matter of fact, I just closed one about a month ago for a veteran who bought a property out in Dripping Springs for $1.2 million and didn't have to put down any money. Now, that's pretty amazing. We didn't see that back in those days. The lowest loan amount I ever did back in 85 or 86 was $40,000. You could actually buy a house for $40,000 back in the 80s. And I had a veteran do that with zero down. So that's the benefit of a veteran loan is zero down. And as long as you qualify for, income and credit, you can pretty much buy anything you want. So those are special designed for veterans. Now, the other category would be FHA. FHA stands for Federal Housing Authority. And those are loans that have been around since, again, probably the 30s or 40s as well. And they're designed typically for first-time buyers, not always, but usually first-time buyers lean more toward the FHA loans, and those require 3.5% down. Now, again, in Texas, we have loan products through the state of Texas where we can get free. Well, I wouldn't say it's free, but it's called grant money from the state for down payment. So even if you don't have any money, you can also get an FHA loan if you qualify with the down payment assistance programs, what we call DPA programs, that are available throughout the state of Texas, certainly in the Austin area. So FHA loans do require 3.5% down. So on, let's say, a $200,000 property, that would be $7,000. Conventional loans, again, for the most part, require 5% down. So again, a $400,000 house would be around $20,000. Now, if you're a first-time buyer and you go conventional, let's say you have conventional is the best loan product for you. We do have 3% down conventional loans as well, and they also would fit into this down payment program. So, again, we look at credit scores, we look at debt-to-income ratios, we look at all sorts of things to see where you would fit, and it could be a conventional product would be the best, or an FHA product. And of course, if you're a veteran, most likely it's going to be the VA loan. Otherwise, Fannie Mae or conforming conventional loans are a limit in this area of $766,250. So the most you can borrow is $766,250 in what we call conforming conventional financing. Over that, you're in what they call the jumbo category. In jumbo, we can do loans up to $3 million. So there's always money available for people if they qualify, but usually the guidelines are a little stricter. They want a little higher credit scores. They want more money down. The debt to income ratios are tighter. So again, we have loan amounts that will go way higher than the 766, but that's called the jumbo world. And when you talk about the non-QM world we talked about just a minute ago, they may want 10 to 20% down. So again, when there's not as much documentation that somebody can provide, the lender says, well, we'll make the loan, but we want 20% down as opposed to 5% down. So it's always a give and take. And my job, again, is to look at your, profile and take it to the lender who's going to get you the best deal. Now, here's another category that's been around for a long time, and it's a special mortgage option. The question is, are there any special mortgage options for senior citizens? And a senior citizen, which I am one now, I'll be 65 in October. It's hard for me to say that, but I'm looking at Medicare. That's a different conversation. But for seniors, a senior in Texas is defined as anybody over 62. And maybe that's a standard for what we call senior citizens. But if you're over 62 in Texas, for sure, there's a mortgage product called a reverse mortgage. Now, it's a little bit different animal, and it's not for everyone, but it is for some people. Some people who may have not planned very well for retirement, but own a home, let's say free and clear. In Austin, maybe they own a home for $600,000, but they don't owe anything on it. But they're a little tight on their income. They may have a pension or Social Security or some IRA, but it's just not quite enough to make it in these inflationary times. And so a reverse mortgage would be where they don't want to sell their home. They want to stay in their property, but they want to tap some of that equity in order to help them live comfortably. A reverse mortgage does that. And so the example, this would just be an example. This wouldn't be exact, but let's say you had a house for $600,000 and you're 70 years old. A lender may make you a loan up to $300,000, about half of your equity position, but you don't make payments on it. It goes in reverse. So it basically increases over the years. And let's say somebody were to do that and they pass away at 80 years old. Okay. The bank never owns your home. You still are entitled to the house. This is where it gets a little confusing. People think they lose their home. That's not the case. If they were to pass away, the rules say they have to, the estate would have to sell that home within 1 year. So let's say at that point it's worth $1,000,000, but because of the what they call negative amortization on the reverse, they may owe $500,000 or $600,000, but there's still equity that the heirs would get. So again, it's a way of staying in your home, getting some cash flow or a line of credit on your current property without having to pay it back until either you move or you pass away. That would, and you can also do it for purchase. So the example, I'm doing a loan now for a couple. They're both in their late 60s. They sold a home in California. They have some cash, but they don't really have any income to qualify for a traditional mortgage. They have quite a bit of assets, but not a whole lot of income. They do have some. But in this case, they want to buy a house for about $800,000. So the lender will say, if you put up $500,000 from your sale, that we can give you a mortgage, a reverse mortgage, and you can buy this property and not make any mortgage payments. You have the option of making mortgage payments, but you don't have to. So that really felt good to them since they don't have a lot of income, but they want to purchase property as opposed to rent. So they can actually buy a house and not make a mortgage payment. They still have to make payments on taxes and the insurance and the upkeep of the property, but there's no mortgage payment, which is going to save them a lot of money monthly. So that's called a reverse mortgage, and that's just for folks over 62. Um, so what are the pros and cons of buying a new home versus an existing home? My personal preference over the years has always been to buy an existing home, but right now there's a lot of people that are moving toward buying new homes, which is fine because the new home builders because in this market are offering some very good incentives for financing. So I'm not opposed to people buying new homes per se, but there are pros and cons to both. The pros to be buying a new home in this market would be, number one, the interest rates are usually lower than you're going to get coming to somebody like me because the builders are offering incentives to buy their properties in this market. That's one pro about buying a new home. And also that you're going to have warranties. So if something goes wrong, the builder is going to back it up. You're going to have a warranty for the property itself, the slab, or the construction, and also sometimes the appliances. You're going to have newer appliances. Obviously, it's a new home, so you're going to have warranties on things like that, which a lot of people love. And they like that new car smell, if you will, of a brand new home. The cons of buying a brand new home, typically, if you're in a new neighborhood, some of these developers will be in that neighborhood and these builders for several years. So for any reason you have to move or want to move, let's say you move to Kyle and the commute's too much, and you say, "Hey, I want to come back further toward town," and you have to sell. You're going to be competing with the builder down the street who's building a brand new home. So it makes your home less attractive. It's going to be hard to sell if you need to move in the first 3 or 4 or 5 years in a new home subdivision. Plus, aesthetically, sometimes it's just not as attractive because you don't have the big trees of some of the more established areas in town that some people like that are larger lots. Usually the new home subdivisions have small lots. They're called master plan communities. They have a HOA that you're going to have to pay into, which is okay because you're going to have amenities like swimming pools or community centers and things like that. So there's nothing wrong with new homes, but on the flip side, what we call a resale property or pre-owned property is such that usually there's going to require some more upgrades. Because my wife and I bought a house a couple years ago in Lakeway, and it was the original owner. They had bought it. They'd built it actually in 1980s. So it was 40-something years old, and it looked like 40-something years old. So we wanted to buy that property because it's on a golf course. It's perfect what we're looking for. But we had to put quite a bit of money into it to make it up to today's standards, which is fine because now it's our home and it looks like what we want to buy. But typically on a resale home, it depends on how old it is, of course, but you may have to put some money into it to fix it up to where you like it, whether it be the kitchen or the baths or the flooring or the siding or even the roof for that matter. So again, that's the cons of buying a resale home. And sometimes the pros are you're in a established area. Like we bought in an established area. There's large trees. It's on a golf course. It's very quiet. Um, there's no view per se, but we do have a nice quiet area, and there's no new construction going on around us for sure. So there's pros and cons to every situation. It's close to, you also want to look at things that are close to your schools or your shopping or your church or things that you're going to, or to your work for that matter. With traffic in Austin, a lot of times a resale is going to be um, more attractive because it's not so much far a commute if you're going to be in Austin area. So next question, what are some of the potential risk of buying a fixer-upper? Lord have mercy, I can talk about this for a while because this is exactly what we did. We bought a property that needed a lot of work, and so the pitfalls, the risk of that is sometimes, even though you may have a very good inspection done on the property, to hire a very qualified property inspection to look at the electrical and the plumbing and the roof, um, and the siding and the slab and everything else. You want to get a very qualified inspector to come out there, but they don't see everything. So once you start digging in and tearing down walls and maybe moving walls around or replacing appliances, you're going to sometimes come across areas that you didn't see. That could be, there's an old movie by Tom Hanks called The Money Pit. Sometimes a fixer-upper could be a money pit. Now, especially as a problem if you're trying to buy that property, improve it, and sell it for a profit. That's called a flip, where you buy a property that needs a lot of work at a discount price. You buy, and then you spend, let's say, $50,000 to $100,000 improving it, and then you want to flip it in order to sell it for more than you've put into it. That's a strategy a lot of people do. We've done it before. The risk is if the market turns on you and you can't sell it for what it's worth, then you've got a problem. You could rent it out or maybe you can move into it. But there are some challenges. You got to be very careful when it comes to buying fixer uppers. And in my opinion, a fixer upper is by definition something that needs at least 50,000, if not more, in upgrades. So let's talk a little bit about veterans. Are there special loan options for veterans? And indeed there are. We talked about this just a minute ago, but Texas is the second largest, behind California, has the second largest number of veterans in Texas. So there's a large veteran population. And veterans, there's lots of reasons that are special options for veterans, primarily that they can buy a property with zero down. Sometimes veterans will put money down to keep the mortgage payment down, but most of them like the option of having to put no money down when they can still borrow money, let's say at 6% or 6.25% today. And they may have other loans they want to pay back at higher interest rates, like could be a car loan possibly, or credit cards or student loans, things like that. The loans that are outstanding that are higher interest rates than a mortgage. So they want to leverage their real estate by putting zero down. And there's also no monthly mortgage insurance. Most loans, when you put down the minimum, you're going to pay an additional fee called mortgage insurance. That it doesn't do anything for the borrower, or the homeowner. It has to do with insuring the loan against default. So it's only good for the lender. So if you, in your case, a case where you're putting down 5% on a conventional loan, you may be paying $100 extra per month over the mortgage payment in order to assure the loan that if something happens and you can't make the payments, the lender will get their money back. That's called mortgage insurance, but it's only good for the borrower. Veterans don't pay that. So there is no VA, what they call VA mortgage insurance. So that's another option. The other good thing about VA loans, they can be assumed. So when I say assumed, let's say in the old days, a few years ago, we were doing loans at, let's say, 3%. If a veteran had a loan at 3% today and the market's 6.5%, then makes their house more, if they want to sell it, makes it more attractive because their financing's in place and somebody can assume that loan and pay them the difference if they want to sell. So let's say they owe $300,000 on a house and their property's worth $350,000. somebody could come in and pay them the $50,000 and take over their loan of $300,000 at 3%, which makes their house much more attractive in the market to sell than it would be somebody who has a conventional loan or things like that. So there's other options, other great specials for veterans, but that would be one of them. And let's talk a little bit about HELOCs. We're fixing to wrap this up, but a HELOC, what are the benefits of a HELOC? I'm getting a lot of calls from people who need some cash out of their home, but they're sitting at 3%. They don't want to refinance into a cash out loan because the rates would be too much higher and their payment would go up too much. A HELOC loan is defined as a home equity line of credit. And I have one on one of my properties. My wife and I have a mortgage on one of our properties with a HELOC. A HELOC is a line of credit. So, a line of credit means that you're only paying it back if you charge it. It's like a credit card. It's an open line of credit on a property. It's a great way to have access to cash if you need it without having to, go get a loan every single time, because the loan's in place. You can charge it, pay it off, charge it, pay it off. And so a HELOC is a very attractive option for people who maybe need $50,000 or $100,000, in the short term. And so if you need some help on that, let me know. Give me a call. My company is Texas Mortgage Source. I've been doing this 40 years, and my phone number is 512-789-6967. I'd be happy to look at your situation, either be to purchase or maybe refinance or maybe build a property. And look forward to speaking with you. You guys have a great day.